Open Market is sponsored by AdLib, the self-serve DSP solution making advertising easy. What do the world's largest demand-side platforms have in common? They're effective, but they require large annual contracts and spend minimums. With AdLib, growing agencies get a single platform that connects to every top global DSP with no contracts, no spend minimums, and G2's #1 ranked support. That means access to the entire universe of TV, digital out-of-home, audio, display, video, and native without a hassle and with no blind spots. It's incredibly easy to use, plus it can automate most of the work your team spends hours a day doing manually. Get the most powerful media buying technology without the barriers to entry. Check out AdLib at getadlib.com today. Welcome to Open Market, a podcast about building companies in the advertising industry. I'm Joe Zappa, and I'm joined by Eric Franchi, who is newly even richer than he was before because he had 2 exits this week. Eric, how does it feel to be fabulously wealthy?
Stop it. Like I said on your post on X, I'm a VC of the people.
You guys should see Eric today. He's like wearing this like white shirt that's like sort of loose. He's like super tan. Like he just looks like he's chilling. Like this is what VCs do all day. They just hang out in their beach house in their summer linens and have a fabulous time while their founders toil away. Isn't that right, Eric?
Absolutely not. But I don't think I'm doing myself any help with the attire and the background here. So
no way to argue against that.
Yeah, I'll let you have that one. Anyway, what are we doing today? What are we talking about?
We are talking about how to become an investor and everything that investors do. But part of the reason we wanted to hit that this week is because you had a very big week with 2 exits for your Aperiam portfolio companies. So why don't you tell us a little bit more about that?
Yeah, it was a big week. It was not a normal week in that, exits, typically are like few and far between. But with the market coming back and a lot of strategics starting to lean in, we had 2 cool deals announced. The first was Beyond Ordinary, which is, a name that folks are not familiar with. It is the company behind Possible, which is the, industry tentpole that's been around for a couple of years. They were acquired by a strategic called the Hive Group. The Hive Group owns a lot of other industry tentpoles, including Shop Talk and other vertical ones. It was a great outcome. It was fast, but I think Possible has been, an anomaly in terms of, just how much progress they were able to make in a couple of years. And then the other one was another strategic acquisition, and this one is super cool. Reddit acquired Memorable AI. So Memorable is an AI startup that's focused on creative. They build models that allow them to understand or predict rather what a brand's KPIs of creative. They basically run creative through a predictive model engine, and then they use generative AI to take those learnings and build better creative as a result. So using Memorable, you start a campaign with way better creative than if you would have not used Memorable. Reddit acquired them because Reddit wants to get into the AI game, which is transforming the business of all the other platforms, Meta, Google, so on and so forth, with their own play in AI infrastructure. So 2 cool deals, 2 of the types of deals that you would expect as an early stage VC, which is exits to strategic acquirers. I think we're at a moment where we're going to see more of these, more returns. So I think people are naturally, starting to, talk about M&A and investing and all that stuff as well.
So our very first episode was about how to optimize for a quick and favorable exit. I mean, I think
both of these are 2-year-old companies.
Right, exactly. That's what I'm thinking. So I think the Memorable folks, they might have been a bit further along than what we talked about in that first episode, in the sense that, I think you said they had product market fit, like they had customers and so on. Nevertheless, how do you think that story maps onto what we talked about in terms of an AI company doing something super buzzy, having tech that, big tech companies are interested in and getting acquired relatively fast?
Yeah, I mean, Memorable was not optimizing for a quick exit, but they just nailed it in terms of, the right offering for the time and a product that works and a great category. And when you do that, all sorts of options start to come to you. They, had a lot of interest from investors to keep going. And they frankly had interest from strategics to sell the whole thing. And they chose option B, and I'm super thrilled for them. They're an incredible team. and just great people. So I couldn't be happier for them.
Yeah. Well, I think when I asked you when we first met, what are the three things that determine success for venture-backed companies? And I think you said right category, right time, right team, right category, right time for sure. I mean,
Mm-hmm.
so makes sense. And then with Possible, so this is interesting too, because Beyond Ordinary, it's not a tech company. It's my understanding it's a media and events company, and I was at Possible this year. It was great. They do seem to have picked up a ton of steam very quickly. I saw in some of the coverage that an explanation for how they were able to pick up so much steam so quickly would be that they brought on, people like you, like they really went with a sort of insiders route, like brought in powerful people in advertising, people with a lot of friends, and that allowed them to gain traction. What's your perspective on how they grew so fast and generated a favorable exit so fast?
Yeah, Possible. I think bit of lightning in a bottle, right? So the idea behind Possible was, okay, we're coming out of COVID. This was this conversations beginning in like 2021 or so. We're coming out of COVID. We think that events are going to come back in a big way. Number one. Number two, there is a gap in, even though there's a ton of events in marketing and advertising, there's a gap for, a US based tentpole event. And, there was a team that was led by Christian who had done it before with DeMexico. So again, looking at the factors that one would, kind of evaluate with an investment, with this as a strategic investment, for a fund that invests in marketing and advertising tech, this was, one that generally doesn't come our way. So we invested on that basis. We were thinking, hey, this is an interesting opportunity, a backable team, and something we can really dig in and have a lot of more influence, and be able to add more value than, in our typical technology investment. I think they did a great job. We were the only fund that invested, I believe. The rest of it was, like a who's who of angel investing. Michael Kasson, Tarkawaja, Jonah and Noah Goodhart, Brian O'Kelly. And those folks not just lent capital. I think they lent a lot of credibility, visibility, attendance, content. They did really well.
I think that's the way to do it. I mean, in particular with advertising events, the trick is always you can get ad tech companies there. Sometimes you can get publishers there. I think the bells of the ball are the brands, right? And
Yeah.
it can be challenging to get them there, but that's where, you really it's just like selling for a tech company, right? Like you need those relationships to get things started fast. So sounds like they had that and they put on a great event in the ideal place at the ideal time. Miami in April, all the New York people are eager to come down. So yeah, congrats to them.
Yeah. I think there's things to be learned from both of these deals for sure.
So let's get into some of the bigger picture questions now. And also, disclaimer, what you are about to hear is not investment advice. This is for entertainment and educational purposes only. Do not make any investments based on anything you hear on a podcast. You are on your own. So,
This is not
Eric,
financial advice.
Eric, how did you become an investor?
We'll hit this one quick because I've told the story in longer forums elsewhere. My path was somewhat unique, but also somewhat not unique. I was a founder in ad tech for a very long time. As a founder, the longer you do it, oftentimes the more you build a network and investment opportunities come your way. So I started to make angel investments, and there were others that were doing the same thing, kind of, investing in the category and companies that they knew well. One of them was Josie, the other Josie, Joe Zawadzki of, at the time, Media Math. We started talking about this idea of professionalizing what we were doing as, sort of like a side hustle of angel investing and building a fund for advertising and marketing. And timing coincided well with me. We had just exited Undertone. I wanted to do more of this for my next phase. So we partnered up, launched a firm, and now it's 6.5 years later. We've invested in over 80 companies. We've had, at this point, probably over a dozen exits, two of which we just talked about. And we're well on our way.
Why start a fund and not start another ad tech company?
It was twofold for me. Number one, I wanted to do something different. It would have been logical to start another ad tech company because, part of the reason why we partnered up on the fund was, we think that the best days of the industry are ahead of us and there's a lot of things to be built, right? So it's I wanted to stay in the industry because I had strong belief in it, but I want to do something different. And then B, if you then believe that that's the case, which is, there's a lot of value to be created. There's a lot of things to do, a lot of things to be built. One of the ways to, I think, build a great business as part of that is to be the financial capital, the financial infrastructure for the industry, which is the path that we chose with Aperiam.
What's the difference between being an operator and a VC?
When you're an operator, and I don't love the term, but it's just, it's sort of this catch-all that people use for, people that like run businesses versus people that invest in businesses. When you're an operator, you're typically all in on your one thing, and you live and breathe your one thing, and you're completely attached to it. And the ups and downs are your ups and downs. As an investor, particularly, sort of as a VC, you're running a portfolio of things. So, the natural ups and downs of a given business, are not your ups and downs. You sort of feel them, by proxy, but you're working across a number of things. So, it's a different cadence. It's a different intensity. It's like being all in versus, being like, all across. It creates a different, way of working, which was one of the things I had to adapt to. I was so used to being all in and, knowing what to do, knowing what the days, the weeks, the quarters goals were when we were doing Undertone. When you're doing a fund, it's completely different. And you might be talking to 10 different companies a day, and the context switching and the inbound and all of that stuff is a different work style. So I think it's A, sort of, that idea of like all in versus all across. B, success as an operator, oftentimes it's down to, at times, just like brute force. You just like work hard, you grind, if you do enough of that, you're going to get to the other side. As an investor, particularly when you're like an early stage investor and you invest in lots of companies, you can't brute force your way into any of it, right? You're just on the outside, at times, at best trying to be helpful. So success as an investor is about you exercising good judgment and not brute force. And when you're used to brute forcing for over a decade, that is a big switch. So again, when people ask me, like, what's the difference? Like, the difference between being an investor and an operator is night and day. And this idea of like, being able to basically profit from your judgment is a real big shift. And it's also something that takes a lot of time. Like when you brute force things, you can make things happen and see results tomorrow. All right, I'm going to email 20 customers and I'm going to set up 20 calls. Anomalies like possible and memorable aside, I'm making judgments today that, will prove to be good or bad in like 5, 7, 10 years. So the time frame thing is also another big mental shift you need to have. So yeah, that's I think some of the, from my perspective, some of the differences.
There are actually some similarities between the position of a VC and the position of an agency owner. Like for me, well, in the sense of concentration, right? So like compare being an agency owner to being a chief marketing officer. When you're a CMO, you're betting on that company, right? You're taking a job and you're tying your future to that of the company and you're sort of going all in. Whereas when you are the owner of an agency, you might have a dozen or several dozen or even hundreds of clients. And in that case, like you're sort of diversified. And then also in terms of how you work, because that is something I really like about agency life as a marketer, is that you're working on like a dozen plus things at any one time. And I like that context switching. Like it keeps me sharp. It's exciting. Some people are like totally overwhelmed and burnt out by that. And I think that's a lot of what you hear when you hear about agency burnout is people are just like, I can't work on like 8 things every day. And they prefer the constancy of one company to worry about.
I get it. I never thought about it that way. That makes a lot of sense.
So what does a VC do all day besides writing 10,000 word blog posts and reading Ayn Rand?
What do they do? They tweet a lot. They vacation a lot.
Shake hands, kiss babies.
Yeah. Talk about politics a lot. There's a lot of stereotypes. In actuality, the job of a VC is to get into the best investments. There's a concept called the power law, which folks can do their own research and reading, but effectively it states this, that most of the value accrues to a small percentage of investments. over time, this has proven to be, relatively true across like multiple asset classes, with the broader heading of private equity and venture, where it's, typically like the outcomes are so disproportionately large that they make up for all of the modest outcomes and all of the losers. So your job as a VC, if you're building a fund, if you're building a portfolio, it is to get into the best investments, full stop. Whether you're a generalist, whether you're early stage or late stage, or a sector focused investor like me, you need to get into the best investments. And that's literally all the job means. So how do you do that? So to track the best investments, and again, it's a little bit of, channeling, Joe Zappa in terms of like thinking about this as a funnel, you need to, number one, attract the best deals, right? So you need to build your deal flow, and you get that by building your brand, building awareness, building reputation. That's number one. Then number two, you need to get into the best deals. So you need to be a good investor. You need to have a good reputation. You need to, be the type of person that the best founders, the type of firm that the best founders want to work with, right? So that's, you could kind of call that the mid funnel. And then number three, assuming you get into, what will prove to be those best investments, you need to do the work to make them successful. Basically, it's, very, very simple. You need to get into the best deals, and you need to build a process for having those best deals come to you, or you come to them, find them, get into them, and do the work to, at minimum, not screw things up, and at best, help, do your part to make them successful. That's the entire job.
And when you do get those great founders, how does a VC help those founders become successful, and what should founders sort of expect from their investors?
I think a lot of people poke fun at VCs, and I think a lot of it is warranted, quite frankly. For maybe the handful that are out there, kind of tweeting a lot and doing all these ridiculous things. But there is a little bit of reputational baggage that has come along with VCs that I think is deserved, where oftentimes they'll screw things up. Like they'll give bad advice, they'll structure investments that or they'll structure deals such that the founders, don't get the best returns. So I think the bar is, unfortunately, for a lot of, the categories, so low that if you are not value extractive, you're in the top 10% or 20% or what have you, right? So it's like the bar is, don't do harm, actually, kind of be helpful. From a being helpful perspective, I think there's, basically two camps here. Being easy to work with in terms of, the job of a VC deploying capital, writing checks, like actually write checks and be easy to work with when it comes to making those investments is number one. And then number two, based on your model as a firm, you're either kind of here when the founder needs you, and, the founder knows where you are, really helpful in terms of making introductions and giving advice and being there for strategic decisioning, sort of like that's kind of camp A. And then camp B is, some of the larger firms like A16Z or Founders Fund, Y Combinator, they'll build infrastructure, and they'll build, sort of like all of these areas where they'll work deeply with a company, have teams that work deeply with a company to help them in a much more formalized way. At Aperiam, we sort of kind of do a little bit of both. But, I would say for a founder, you should work with VCs that, reputationally are known for being good players, easy to work with, and create value, and look to distance yourself from, the opposite. And then depending on your needs as a founder and as a team, it's, picking a firm that, has the sort of kind of post-investment value creation process that makes sense for you.
In terms of founders figuring out which firms to work with, I've heard founders say that it can actually be tricky either to pitch VCs who know a ton about your industry, or to pitch VCs who know nothing about the industry. And that often there's like a benefit to finding a sweet spot, because if they know nothing about your industry, they just have no context and it's hard for them to envision success. But if they know too much, sometimes we get a little jaded or cynical, and we're like, oh, well, that will never work for like X, Y, and Z reasons because I know so-and-so and it didn't work out for them. How do you think about that?
Yeah, that's, I think, very good point. So to find the best investors, oftentimes like founders just talk to other founders. right? So, you can get the inside scoop on who is good to work with, who is easy to, kind of engage from a process standpoint, and who to stay away from, right? So my advice oftentimes is like, if a founder is like, diligencing us and trying to figure out if we're a good fit for them, I'll say, hey, go to our website, look at all the portfolio companies we've invested in and the founders that have given us testimonials, and just talk to them. I think that's the simple advice. In terms of sector expertise, non-sector expertise, like all I do is ad tech. So my bias is for investors that, know the sector and invest actively in the sector. That said, we're a minority in that most firms, if you look at like the thousands of firms that call themselves venture firms, they will be generalist and they'll be typically like stage centric, right? We're a pre-seed firm, we're a seed firm, we're an A and B firm, right? And so on and so forth. And they might, have a few categories that they focus on. Broadly, it could be B2C or B2B. And when it comes to B2B, it could be like enterprise SaaS and life sciences and so on and so forth. I would say that it's hard for a generalist, unless they're like really, really good in terms of giving like, general advice and, intros to downstream investors and all that stuff that I think, kind of VCs can do well across categories. It's difficult to a founder to expect anything more than just like capital and investor intros from investors that don't know the sector that they're, investing in on more than a cursory level.
I tend to agree. Again, parallels between, marketing services and VC. Like this is a perennial discussion in marketing circles is like, do you need someone when you're hiring a marketer, either in-house or externally, do you need someone who knows the industry, or can you just hire a smart generalist who will learn? And people will, of course, make the argument, and I agree with this, like, a really smart generalist like can learn, and they can learn pretty quickly and whatever.
Sure.
But my perspective is always just that, I mean, yeah, they can learn, but if you had to choose someone who's written like 1,000 articles about your topic or someone who's written none, probably go with the person who's written 1,000, assuming that their like general marketing capabilities and writing skills are the same, right? If you're holding that constant, you would rather get someone who knows, because someone who knows the industry, and again, I think this holds true across investing and marketing, like they're going to be able not just to re-articulate what you say, but to understand like where the holes are. Are you really saying something interesting? What is the consensus and how are you bucking that consensus? Where are the pitfalls that other people have fallen into and how might you be falling into them? I think it takes knowledge of the industry to offer that level of value that you probably really want from an investor or, a services provider.
I agree. When we're talking to potential investors for our fund, like what we need to do is articulate how we're going to have an edge because we're so focused. We've got the brand, we tend to attract a lot of deal flow. So our edge is not necessarily in, attracting a deal flow. It's almost like, hey, if we continue to be visible, we're going to get it. Our edge is really understanding where the industry is going, being close to the industry, doing nothing but living and breathing in ad tech. You got to think about those three things that you do to get into the best investments. Our edge is going to be, I think, having an idea of where the market is going, right? And investing in those sectors and teams that are doing that. And then B, being able to do things that can actually help move the needle for them, whether that's advice or introductions to customers, introductions to service providers that, are good specialists in the space, so on and so forth. So, again, because this is all I know, and I'm sort of kind of giving my pitch to you right now, but in investing, it's hard to have an edge because so much is out of your hands, right? You're not hands on keyboard, building the thing, selling the thing. So you need to have as many of those edges as possible. And to me, having that sector focus is one of the obvious ways to build an edge.
Putting our founder hat on, a lot of our listeners are founder CEOs in ad tech. How does the deal process work? How do they approach you, and how does it go from there?
Again, it's, kind of almost think of this as the funnel, right? So the first thing you need to do is get on the radar. Generally, this is somewhat controversial, but in general, getting a warm introduction, if you don't already know the firm, getting a warm introduction from another founder or a trusted partner or co-investor, getting an introduction to the partner at the firm is typically the right way in. So much of investing runs on, like trusted networks that have been built over time, right? People want to work with people that they've had good experiences with, that they've made money with, that they know, get into good deals or are good founders, right? So if there's a way for you as an unknown quantity, as a raw 0 to 1 startup that has no visibility, no awareness, no reputation out there, there's a way for you to come in through the side door via a warm introduction. That's typically the best way to get on the radar. That said, I've invested in companies that came to me via a cold email. A couple of our best investments were like a cold email where the founders just had like a great, well-crafted pitch that, like made me take another look. But the reality is investors' inboxes are so jammed up and have so much noise and so much cold inbound that any way you can rise above and get like, a warm intro of sorts, that's better. And I say this, that it's controversial because that also kind of sucks. If you don't have those networks built up, if you don't know other founders, if you're just like a person in a part of the world where, you're just like trying to break in and you just don't have those networks built up, it's tough to do. But then on the other side, like, hey, you have all these tools at your disposal that, you, Joe, talk about all the time in terms of posting and putting, content out there on X and building up your own reputation that over time, like people get to know you if you show up in their inbox. So bit of a double-edged thing there.
I was thinking the exact same thing that, if you do find yourself in that position where you're like, well, that's not fair, Eric. I don't have that network or that reputation. I mean, the purpose of marketing is to build your reputation and relationships. So that goes for finding customers, obviously, when you're in that 0 to 1 phase, but it also goes for finding partners and investors and other people who are going to, kick you up a level. So if you're starting out in a new sector or you're starting your career, your company, and you don't have that network, you should be finding where those people hang out online and you should engage with them thoughtfully and share what you're doing, because that is the way nowadays to close that gap if you don't start out with that relationship advantage.
Yeah, it's the great equalizer. And again, Joe, you didn't get an intro to me, right? Yeah, so something to be said for it. Okay, all right. So let's say you're in the inbox, you're on the radar. I would say that most investors, it's a pretty similar process. So, you should be in the inbox with a well-crafted, succinct pitch. You should attach your fundraising deck and you should expect a response if, it fits the thesis and the stage and everything that an investor is looking for. From there, typically the partner on the deal will spend time getting to know the team, digging into the product, digging into the model, gaining a thesis around it and conviction around it. And then from there, the partner will bring the team to a partner meeting where the rest of the firm will hear the pitch, have done, I think, the pre-reads that the partner that's sponsoring the deal has put together on why the firm should invest in the company. And then from there, a decision is made. And then really the work begins there in terms of negotiating and cutting the check and doing the post-investment work to, build this company into something that hopefully is very successful.
What are some of the features of a good pitch and what are some of the features of a bad pitch?
Ooh, okay. I think a good pitch, tells a story of the future and is done in a way that is so compelling that it makes the investor believe that, number one, this future is inevitable. And then number two, the only team to do this is this team. So that's very broad and general, but, at its core, and I'm an early stage investor, right? Like oftentimes I'm investing pre-product or very, very early. So much of this is around the team, the vision, and the opportunity. You need to just be telling the story. And that's, I think, consistent irrespective of the stage, right? So much of this is about, this is what the world is going to look like in the future. And this is why we're the team to do it. And this is the product that's going to make it happen. The best pitches, ultimately, at the end of the day, this is what they are. I have my own kind of, pet peeves or things that are turnoffs. And this might be a little bit inside baseball to, founders pitching VCs, but we could talk about it. So number one, oftentimes founders are very protective of their ideas, understandably,
Mm,
and, won't send a deck or will ask for an NDA to be signed before there's even a conversation. Those conversations typically go nowhere. So number one, like I need something to review to just judge for fit, judge for stage, judge for some of those things that are just like, check the box criteria. And then number two, VCs don't sign NDAs. It's like a industry practice. So, asking for, an NDA to be signed, I think tips the hat a little bit in terms of the level of sophistication of the founder, right? So it's like couple that stuff, in the beginning. If I see that, you don't even make it past like go, things to, consider not doing, in terms of your like pitch deck and your conversation, talking about your vision of like what the exit is. When you are two founders in t-shirts with a PowerPoint and nothing more, and like talking about how, in 5 years' time, it is inevitable that Reddit's going to acquire this company. It is inevitable that IAS will need to acquire this company. Again, that stuff never happens. And, frankly, like building, as we talked before in our earlier episode, like kind of building for a quick exit is not, what investors are looking for. So like painting the picture of, like what our inevitable exit is at an early stage, right? If you're, a big business, that's the different rules apply. That I wouldn't recommend. Sometimes, founders want to bring on a lot of advisors and they'll have like their team slide. And then they'll have another slide with like 10 people that are advisors to the business. And it's just like, I've never seen like that stuff actually turn into something that's like highly productive for the company. So the wall of advisors that, just have equity in your business and God knows what they're doing, I would not recommend that. Or for me, that's a pattern that I don't love to see and I haven't seen it been successful. So there you go. A couple of things I like, a couple of things I don't like.
that makes a ton of sense. I mean, I think that's an interesting nuance between painting a picture of a very successful future company versus saying, and this is exactly how we will be successful and get you massive returns is, this specific company is going to buy us or something like that. Like that could be lost on people because I get that a founder's head is naturally going to go to those places, but getting overly specific at a super early stage isn't necessarily realistic or helpful. And then the other thing is I see that too in marketing is early stage founders will sometimes be very protective of their ideas. And that actually prevents them from getting out and building a reputation for the company and getting customers and other supporters because they're like, well, I don't want to give away the secret sauce. And it's like, it's probably not going to be that like you did a LinkedIn post and then someone else stole your idea that prevented you from being successful. It's much more likely if you end up being unsuccessful that it'll be because just no one cares and no one knows about you. That's what we want to avoid. And that's a much more common fate. So I think generally you're better off erring on the side of sharing more as opposed to sharing less.
I agree completely. And there's so many cliches that apply to so much of this stuff. And it's what is it? Ideas are a dime a dozen. It's all about execution. Success is like, 10% inspiration, 90% perspiration. I think there's, a lot of that stuff applies here. It's all about doing the work. It's all about execution. And yeah, I think you're right in that, holding back those ideas, I never really considered, the harm it might do from a reputation and marketing perspective. All the more reason to be out there, both in terms of, your fundraising and your general marketing.
If someone wants to become an investor or VC, what advice would you give them? And I guess there are sort of different situations here. There's like you could be a founder like you were who has an exit and then is interested in doing investing. You could be a person in the industry who just gets approached to do angel investments. You could also be someone who's relatively young and just wants to enter venture capital through the professional route, like as an associate or something, someone who gets out of school and does consulting or finance or something and then wants to specialize in venture. So what are some of your thoughts on that?
Yeah, if you want to pursue a career in venture, yes, there's the route where you can, start as an associate and work your way up. and be a professional investor. I think that's, clearly a path that, frankly, many successful investors have taken. They're just career investors. One of the greatest of all time, Fred Wilson from Union Square Ventures. He is a professional investor. I don't know if he's ever had an operating role. I might be wrong about that, but reputation, I think so. Again, I'm biased because this is me. I think there is something to be said for having operating experience, like literally knowing how business works, how companies work, how, ups and downs happen, that make you, frankly, a better, sharper investor. So from my perspective, I think, having, frankly, a career or a fair amount of experience will make you a better investor. And then, I think that's sort of kind of path 1A. If you want to be a VC, you need to have a lot of capital to invest. So that means you either are going to need to have your own career that produces that capital, or you need to be a person that's had such a career that you can attract that capital, right? And that only comes over time, quite frankly. So, I think the best path for a younger person or a person newer in their career is get a lot of experience and then, see if this path is for you at the right time. All right. So that's, the venture route. Then there's the individual route. I don't think that the average person should invest, just period. So the odds are against you with any individual investment. Like, there's no such statistics out there of the percentages of startups that fail versus are successful. And, the odds are against you of any individual investment working out. So making a handful of angel investments is probably a very good way to lose the money that you make in those angel investments. That said, if you have the capital to invest in startups and you want to do it for things that are not just about the financial return, and you have the capital that, you're willing to see go to zero, because let's assume your investments will go to zero, but you want to have a connection to the startup ecosystem. You want to work with early stage teams. You want to put your knowledge and network to work. You want to be helpful. You want to get the knowledge and build your career. Investing is an interesting way to do that. That has way more at stakes, and gives you a way to have skin in the game above and beyond just kind of being an employee at a startup. So I would say if you're an accredited investor, you have capital that you've earmarked for risk capital, you don't mind it going to zero, and you would be happy if it went to zero because you can come away with a lot of the non-monetary benefits of investing, then sure, you can go for it. But the average person, I don't think investing is for them.
Makes sense. You guys should know that Eric and I do an outline before these shows, and we had the question, what should the average person consider regarding angel investing, or should they do angel investments? And Eric just wrote, nope.
I mean, it's just true. I am all in. My career is investing. This is all I do. This is all I've done for 6.5 years. This is all I'm going to do for a long time to come. This is a serious business. There was an era in time, the ZERP era, where it seemed like anybody could be an investor. All startups went from 0 to 100 million, just success. That is not the reality of things. So I'm just recommending that the listener approach this with the proper rigor and seriousness of investing your hard-earned money.
Of course. And I think people get that because even nowadays, I don't know, people in my generation were very much raised by the boglehead, diversification, index funds. I think the average professional nowadays is pretty much an index fund investor. And I think the average person understands that is the right approach for, 95+% of people.
Yeah. But that said, you know what? This is how I got into it. I was able to, have some capital. I was able to, get my, sort of network my way into interesting investments. I invested only in what I knew and people I knew, right? So again, you need to have some sort of edge. I wasn't some dentist in the Midwest that, got a cold email from some startup and was like, all right, cool. This thing looks like $1 billion company. I was super, super focused. Jonah Ryan, O'Kelly, Joe Z, Zwadsky, they were super, super focused and made a lot of investing. So for sure, there are people that have had like incredible success with angel investing. Just the odds of any given investment, working out and becoming that $1 billion outcome, it's just so against you.
Right. So diversify, folks, and if you have enough money, give it to Eric and he'll take care of it for you. You'll have your own beach house in New Jersey in no time. You'll be looking, let me just say, you'll be tan, you'll have cool glasses, cool hair, and you'll be chilling in your linens. That's what VCs do.
That was not investment advice. You should not invest in randos on podcasts. I am not raising money from you people, but we're all friends.
Right, right. Don't come to Eric, guys. Leave him alone. But do subscribe to this podcast because we need your attention and your love. That's just an emotional need that we have.
Yeah, absolutely. Give us a 5-star rating, smash the like button, leave a comment. It allows us to grow the podcast, and the guest pipeline that we have coming over the course of the next few weeks is like ridiculous. And we only get that through you guys listening to the podcast and helping us grow.
That's true. Ad tech A-listers coming your way. All right. I think that's a good note to end on. Thanks,
awesome.
Eric.
Thanks, Joe. Always a pleasure, man. Take care.